The 401k was born in a footnote, not a retirement plan. A footnote. Section 401, subsection K of the Internal Revenue Code of 1978, a tax deferral mechanism created specifically so corporate executives could avoid paying income taxes on deferred bonuses. That was it. That was the whole thing. A benefits consultant named Ted Benna was trying to help a bank reduce the taxes its senior executives paid on their bonuses. He figured out you could defer the cash payout and cut the tax exposure. He pitched the idea. His client declined to use it because of fear that once the government realized the tax loss potential, the provision would be repealed. So, after the client rejected it, Benna persuaded his own company to use it. And that started the first 401k savings plan in 1981. He later called it a monster. Quote, "The system is too complex. There are too many investment options, and people are making decisions they don't understand." Meanwhile, a 2026 report from the National Institute on Retirement Security found that the median working age American has only socked away $1,000 for their golden years. Not $1,000 per year of retirement, $1,000 total. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. That gap between 1,000 and 1.46 million is not bad luck. It is an engineered outcome. And today, I'm going to show you exactly how the engineering works. Here's my promise for the next 30 minutes. I'm not going to tell you the 401k is evil. I'm going to show you the three structural mechanisms. I'm calling them the three locks that guarantee most people will retire with dramatically less than they expect, even if they do everything the brochure tells them to do. And I'm going to show you what the people running the system quietly know that the rest of us are not supposed to work out. Before I do that, I want to give you one mental model that I'm going to keep returning to throughout this video because it frames every number I'm about to throw at you in a way that actually sticks. In the late 1800s, coal companies in Appalachia built entire towns. Workers lived in company-owned houses, paid rent to the company, bought food and clothing and medicine at the company store, and were paid not in dollars but in company script currency that could only be spent inside the company's own ecosystem. It was a closed loop, perfectly optimized. You earned from the company, and every dollar you spent found its way back to the company. You weren't a slave. You could theoretically leave, but leaving was complicated, expensive, and the system made it psychologically easier to stay. The term for the whole structure, later, was debt peonage. You owed so much to the company by design that exit was functionally impossible. I want you to hold that image because in 1981, without anyone fully realizing it, individual participation in the stock market through 401ks helped fuel the go-go days of Wall Street in the 80s and birth asset management juggernauts like Fidelity, Vanguard, BlackRock, and dozens of others. By the mid-80s, the mutual fund industry had multiplied many times over, along with the ranks of well-paid professionals on Wall Street peddling the funds and taking high management fees for doing so. And in 1980, 38% of private sector workers in America had a defined benefit pension, a guaranteed monthly income for life, funded and managed by their employer. Today, that number is approximately 15%. Welcome to the company store. That phrase is going to keep coming back, not as a conspiracy theory, as a systems thinking diagnosis. Because every problem I'm about to show you has the same underlying architecture. You are inside a system designed by others, optimized to serve others, and which you cannot easily exit without paying a penalty. That is the structure. And understanding the structure is how you stop being a victim of it. In a few minutes, I'm going to show you a number involving forgotten retirement accounts that is going to genuinely shock you. But first, I need to show you something about the numbers everyone is already looking at, because they are doing something very specific to your perception of reality. The average 401k balance at the end of 2025 was $146,400, according to Fidelity's data, covering 26,000 corporate plans and more than 24 million participants. Financial media ran that headline. Record highs. retirement readiness improving, 146,000. Okay, not amazing, not terrible, but the average balance was considerably above the median balance of $34,400. The median, of course, is the midpoint below which half of all account balances are lower, 146,000 versus 34,000. The same data set. Two completely different stories about the same population. The average gets inflated by the top earners, the executives, and high-income participants who've been maxing out contributions for 20 years. Those people are fine. Their numbers pull the average up for everyone else. The headline says, average. Your retirement is determined by your actual balance. Nationwide, in 2024, the average 401k balance was $148,000 compared to a median of $38,176. That nearly fourfold gap shows why averages can feel out of reach. Now take the group closest to retirement. The median retirement savings for Americans aged 55 to 64 is $185,000. They need $1.46 million. They have $185,000. That is not a retirement savings gap. That is a retirement cliff. And roughly 29% of those surveyed said they have no retirement savings at all. Nearly 2/3 of retirees, about 64%, said the United States is in a retirement crisis. Here is the reversal I need you to sit with, because this is the cognitive reframe that changes everything that follows. You think the problem is that Americans are not saving enough. That's true, and it's also exactly the narrative the system wants you operating under, because it puts 100% of the responsibility on the individual worker and removes all pressure from the structural design. The actual problem, the one we're going to spend the rest of this video on, is that even the people who do everything right, who contribute every paycheck for 25 years, who never cash out, who never miss a contribution, are still facing 3 structural extraction mechanisms that quietly and mathematically reduce what they'll actually have. By the way, hit subscribe if you like this content. Otherwise, YouTube's algorithm may never show you my videos again. Let me walk you through the 3 locks. Lock number 1 is fees. And I'm not going to be vague about this because vagueness is exactly how the system survives. Over a lifetime, fees can cost a median income 2-earner family nearly $155,000 and consume nearly 1/3 of their investment returns. That's from a study by Demos. 1/3 of your returns gone before you see it, not to the market, not to taxes, to the system. Let me do the math in a way that actually lands. Take $100,000 invested over 30 years at a 7% return. With 0.5% in fees, that account grows to about $574,000. With 1.5% in fees, it grows to only about $432,000. That is a $142,000 difference funds lost entirely to fees. $142,000. Same market, same return, same 30 years, same contribution. The only difference is 1 percentage point in fees, 1% per year. On your monthly statement, that rounds to something like $1.50 on $100 of balance, invisible. Over 30 years, it's $142,000. The US Department of Labor's own example shows even more starkly. $10,000 invested at 7% over 20 years becomes $227,000 at 0.5% fees, and only $163,000 at 1.5%. A 1% difference in fees and expenses reduces your account balance at retirement by 28%. And those are only the visible fees. 401k fees fall into 3 categories: investment fees, administrative fees, and individual service fees. The investment fees are the expense ratios inside the mutual funds. The administrative fees are for record keeping, legal compliance, and auditing. The individual service fees are for things like taking out a loan or requesting advisory services. If you work at a smaller company, high fees can drain your savings over time. For small plans, average fees can range from 1.5 to 2% a year. A 1% difference in annual fees costs approximately $469,000 over a 30-year career on a $200,000 portfolio with $10,000 in annual contributions. That's more than twice the original balance going to fee layers that many participants aren't fully aware of. Here's where the psychology gets dark. Many investment professionals say 401k fees are hiding in plain sight. Administrators don't send bills every year to demonstrate how much you're paying for plan management and services. They also don't itemize fees on statements. Instead, fees are shown through the plan's reduced net returns. You open your statement, you see your balance went up, you feel fine. Somewhere between the market return and the number on your statement, fees were already extracted. There's no line item. There's no invoice. There's no moment where you consciously decide to pay. The money is taken off the top before you ever see a number. There's a government document sitting in your email inbox or in the onboarding materials from when you started your current job called the 404A 5 disclosure notice. It is legally required to warn you that fees can substantially reduce your retirement savings. A FINRA Investor Education Foundation study found that investors with the lowest financial literacy scores pay fees more than 10 times higher than those with the highest literacy, 10 times. So the people who most need their savings to work are the ones the system charges the most. Imagine your plan administrator handing you a document titled, "Warning, this account may significantly reduce your retirement savings." You sign it, put it in the file folder next to your car warranty, and spend the next 30 years confident that someone else is handling it. That document exists. That is exactly what the law requires them to tell you. And the system, correctly, has concluded that most people will not act on it. Welcome back to the company store. Here is the part that never makes it into a retirement calculator. Knowing these numbers and actually building a system around them are two very different things. I spent months going through 50 years of actual retirement data and distilling it into a framework I call the Exit Code, a digital book, 8 chapters of pure research with no filler, built on the mathematical reality of what it actually takes to exit the workforce on your terms. 2 things I'll mention here that connect directly to what we're discussing. There's a section on what I call the 4% trap, the widely cited rule that you can withdraw 4% of your portfolio per year and never run out of money, and why that rule breaks down in exactly the market scenarios that are most likely to occur the moment you retire. The dynamic withdrawal method I lay out replaces it with something that adjusts based on actual market conditions, not a static assumption from a 1994 study. And there's another section on what I call the 58% rule, because over half of workers who plan to retire at 65 are actually forced out of the workforce earlier, most often by health events, layoffs, or caregiving situations. If that happens to you before you've built a specific buffer, the sequence problem I'm about to describe becomes something close to irreversible. You can get it for less than a single hour with a mediocre financial advisor through the link in the description. Now stay with me, because lock number 2 is the one that sounds mundane until you see the total. As of July 2025, nearly 31.9 million 401k accounts are considered forgotten or left behind, holding a combined $2.13 trillion in assets. 3.5 million accounts were left behind in 2023, 4 million were forgotten in 2024. Another 4.2 million are predicted to stray in 2025. The average balance of a left behind 401k has increased meaningfully, reaching $66,691, $2.13 trillion, sitting in accounts, paying fees, owned by people who don't know they own them. Here's the mechanism. When you leave a job and don't roll over your 401k, you become what the plan calls a terminated participant. Once you're a terminated participant, the former employer may cease subsidizing administrative fees, shifting the burden entirely to you. Over time, these added charges, combined with underperforming or default investment allocations, can chip away at returns. Your account defaults to a conservative fund, often a stable value or money market, and sits there, growing at something like 1.5%, while the market triples. Forgotten 401k accounts could cost an individual over $500,000 in foregone retirement savings over 30 years in a worst-case scenario. $500,000 from one forgotten account. Not from bad investments, not from a market crash, from forgetting to fill out a rollover form. Workers born between 1957 and 1964 held an average of 12.4 jobs before age 54, according to the Bureau of Labor Statistics. 12 jobs, 12 potential orphaned accounts, 12 sets of fees accumulating on money the owner doesn't know is sitting there. And the system provides no automatic consolidation, no notification, no centralized dashboard. Each plan has its own administrator, its own rollover process, its own rules. Ongoing complexity in the 401k rollover process has pushed unrelenting growth in missing retirement accounts. As each 401k provider determines their own process, there is little room for uniformity or standard protocols for transferring retirement assets. The Department of Labor launched a retirement savings lost and found database in December of 2024. That's right, the database to help Americans find their own retirement money launched just over a year ago. Before that, there was no centralized mechanism to recover what you'd lost. There's a phrase in business for a product design that profits from its own complexity. I'll leave you to apply the appropriate term here. Now here's a subplot thread I want to bring back. Ted Benna created his first plan in 1981. The pension to 401k shift that followed was not his doing. It was the doing of corporate executives who recognized that switching from defined benefit pensions to defined contribution, 401ks eliminated a massive liability from their balance sheets while generating enormous fee revenue for the financial industry. The people who made that decision were in their 40s and 50s in the 1980s. Their own pensions, already earned, were not affected. This is the moment where I need you to stop and really sit with that. The executives who engineered the switch from pensions to 401ks made that decision from inside a system where they personally were already protected. They had their pensions. They didn't need the 401k to work. They needed the company's balance sheet to look better. And they needed Wall Street to have a new, steady stream of retail investment capital. Both goals were achieved. The workers who came after them inherited a system designed not for their benefit, but for the benefit of the people designing it. One generation's exit from risk is another generation's locked gate. And now lock number 3. This is the quiet one. The one that can undo everything else, even if you did everything perfectly. Sequence of returns risk is the danger that the order in which an investor experiences market gains and losses, not the average return itself, will determine whether their portfolio survives a multi-decade retirement. The same string of annual returns, rearranged in a different order, can mean a comfortable 30-year retirement or financial ruin by year 18. Let me make this concrete. 2 identical investors, same amount saved, same portfolio, same average annual return over 30 years. One retires in a good year, one retires in a bad year. A working investor who saves $1,000 per month and earns 7%, then 7%, then 7%, ends up with the same balance as one who earns negative 10%, then 7%, then 24% provided no withdrawals are taken. A retiree drawing $40,000 per year out of a $1 million portfolio does not have that luxury. Once withdrawals begin, losses hurt more because you're selling assets at lower prices and have less capital left to recover when markets rebound. If the market declines 20% in your first year, your portfolio drops and your next withdrawal represents a larger percentage of what's left. That snowball effect can shorten your retirement horizon by years. The historical case study here is brutal. The 2000 retiree faced what may be the modern era's harshest sequence. To the dot-com crash of 2000 to 2002, a 49% drawdown in the S&P 500, followed almost immediately by the 2008 global financial crisis, a 57% decline. 2 devastating bear markets within 9 years of retirement created a lost decade in which a 4% inflation-adjusted withdrawal strategy left the retiree with roughly 60% less wealth by 2010 than the same strategy delivered to the 1990 retiree. 60% less wealth. Not because of what they invested in, not because of fees, because of which year the calendar happened to put them in when they stopped working. This is where the 401k model fails at the fundamental structural level. During accumulation, while you're adding money, the order of returns essentially doesn't matter because you're buying more shares when prices are low. But during decumulation, when you're withdrawing, the order is everything. You're selling when prices are low, you're locking in losses, and the shares you sold to pay rent in year one of a downturn are not there to participate in the eventual recovery. Workers retiring into a down market withdraw funds for everyday living expenses, selling low and locking in the loss with assets that are therefore unavailable for the eventual recovery. It can decimate the portfolio to the point where it will most likely never recover. The 401k system has no answer to this. Your target date fund gradually shifts to bonds as you age, which reduces some volatility, but it doesn't know whether you're retiring in a bull market or the beginning of a multi-year crash. The standard financial planning advice: save 15%, maximize your contributions, stay diversified, is entirely correct during accumulation. It is almost entirely silent about what happens at the transition. The system tells you to build the balance and has very little to say about protecting it once withdrawals begin. That's not an oversight. That's the end of the system's responsibility. This is where I want to show you what the numbers look like for a real person. Take Marcus. Marcus is 52. He works in mid-level operations at a distribution company, earns around $75,000 a year. He's been contributing to his 401k since he was 27. He's changed jobs 3 times. He currently believes he has around $200,000 saved. What Marcus actually has, his current account, which has been running for 8 years, holds approximately $130,000. His account from a job he left in 2016 holds approximately $51,000. But it's been sitting in a stable value fund since he was offboarded, growing at around 1.8% annually, while the market tripled. And there's a third account from a job in 2009 that he genuinely forgot about. Based on Capitalize's average balance data for left-behind accounts, that third account likely holds something in the range of $40,000 to $50,000. The average balance of a left-behind 401k has increased meaningfully to $66,691. Marcus has about $230,000, more than he thought. But his current plan charges 1.1% in total fees. He's at a small company and his forgotten account is bleeding slowly. He has 13 years until he wants to retire. At 1.1% in fees on his current balance, compounded annually, he'll lose a meaningful chunk of compounding over that window. The DOL's own example shows how a 1% fee difference over 20 years reduces an account by 28%. On $200,000, that is $56,000 of compounding he will not have. Marcus's projected retirement balance at current trajectory, somewhere between $310,000 and $360,000. What he needs to maintain his lifestyle over a 30-year retirement, somewhere north of $900,000. The median 401k balance across Vanguard's nearly 5 million participants sat at $44,115 at end of 2025. At a standard 4% annual withdrawal rate, that represents about $147 per month. $147 per month from the median American's retirement account. That's not a retirement, that's a rounding error. Now, here's the other thing that is happening in real time underneath the positive headline numbers. In 2025, 6% of people enrolled in Vanguard. 401k plans made hardship withdrawals from their accounts, up from 5% in 2024. That's up from an average of about 2% before the pandemic. People are not raiding their retirement accounts because they're irresponsible. The average hardship withdrawal was roughly $5,400, with medical bills, rent, and mortgage payments. And avoiding eviction cited as the top reasons workers are raiding their retirement savings early. A $5,400 withdrawal at age 30, assuming 7% annual returns, would have grown to roughly $41,000 by age 65. The long-term cost of short-term survival is enormous. And this is where the behavioral trap completes itself. The people with the lowest balances who most need the 401k to work are also the most likely to face financial emergencies that force early withdrawal. Workers disproportionately affected by income instability are hourly wage workers. Vanguard's data shows that 42% of hourly workers cash out their 401k when they switch jobs. They pay a 10% penalty on top of ordinary income tax. The account disappears. the clock resets, and they start over 10 years later with nothing but the institutional advice to max out your contributions. Over half of American households, 54%, report having no dedicated retirement savings at all, according to the Federal Reserve's Survey of Consumer Finances. That is the kicker. The system processes tens of trillions of dollars through 401ks every year. The headline numbers all look like progress. The median balance tells you a completely different story. And the hardship withdrawal rate, rising every single year, tells you the structure is cannibalizing itself. The same people who need the system most are the ones most likely to break the glass in an emergency and find the account nearly empty. Welcome back to the company store. One last time. Over half of American households report having no dedicated retirement savings. Roughly 54 million private sector workers lack workplace retirement benefits entirely. And for the people who do have access, median balances for the generation closest to retirement are roughly $185,000 against a stated need of $1.46 million. The system is not failing accidentally. It is succeeding at what it was actually optimized for, converting American payroll into management fee revenue at scale while providing enough tax benefit to make participation politically defensible. Now, here are 3 things specific to this exact problem, not generic advice that you can act on. First, calculate your all-in fee, not your expense ratio. Your expense ratio is 1 layer of 3. Call HR and request the 404A5 fee disclosure notice. Add up every percentage. If your total exceeds 1% and you have the ability to roll funds into an IRA with a low-cost broker, the math over 20 years is not close. A good 401k expense ratio is under 0.10% for index funds, under 0.20% for target date funds, and under 0.50% for actively managed funds. If your plan is charging 1.3% and your employer has no matching contribution on the marginal dollars, you may be better served putting additional retirement savings somewhere cheaper. Second, treat every single job change as a mandatory 60-day financial event. You have 60 days to roll over your old account into an IRA or a new employer plan without tax consequence. Set a calendar reminder the day you resign. The danger in a forgotten account isn't neglect, it's active leakage. Once you become a terminated participant, the former employer may cease subsidizing administrative fees, shifting the entire burden to you. The system is not going to remind you. It is financially incentivized not to remind you. You have to move it yourself. Third, before you retire, stress test your withdrawal plan against a 15 to 20% market decline in year 1, not in a spreadsheet that assumes average returns throughout. In a model that assumes the worst comes first. Many financial planners suggest keeping 1 to 3 years of planned withdrawals in cash or very short-term bonds. If you need $70,000 a year from your portfolio, keeping $140,000 to $210,000 in stable assets acts as a shock absorber against forced selling at the bottom. This buffer doesn't eliminate sequence risk, but it buys you the time not to crystallize losses in year 1 of what might otherwise be a recoverable market downturn. None of this is complicated. All of it is available in the documents your plan is required by law to give you. The knowledge is in plain sight. The issue is that reading fee disclosure documents for fun is not how most people spend a Tuesday evening, which is why I do it for a living. And why, when I run into Ted Benna at the end of the story, the guy who spent 15 years trying to reform the monster he built, who watched the pension disappear for an entire generation, who now runs seminars for small businesses trying to offer their employees something better, I find him more interesting than depressing. He didn't set out to build a company store. He built a clever tax solution in 1979, and history did the rest. The people who turned his footnote into a $5 trillion industry, they knew exactly what they were building. Lazy investing built more fortune than crypto memes. And the single most leveraged financial decision available to you right now costs nothing and takes 45 minutes. Open the fee disclosure document sitting in your email archive, add up what you're actually paying, and check whether any of your old jobs are sitting on an account you forgot to close. The system is counting on your inattention. It has been for 40 years. That's not cynicism. It's just reading the incentives. In 1980, 38% of private sector workers had a defined benefit pension. The man who replaced it with the 401k called it a monster. The median working age American has $1,000 saved. These are not disconnected facts. They are the same story, told from 3 different angles.